Washington, D.C. Companies that operate in those insulated areas are protected from recessions, as are pharmaceutical firms, because people aren't going to stop paying their drug bills either.
So you think the drug makers are still going to perform relatively well, even with healthcare reform?
Well, obviously, healthcare stocks are a little bit less certain than consumer staples or utilities, but no matter what happens with healthcare reform, people aren't going to stop taking their Lipitor. Another thing that blue chip pharmaceuticals have going for them is that they all pay huge dividends. So there are ways to protect yourself in the stock market during a recession. And if you want to get more creative, we can talk about stop loss orders or inverse ETFs.
Okay, and that's exactly what we're going to talk to our next guest about. Nilus, thanks so much for being here.
Thanks for having me.
Okay, coming up, special picks and pans focusing entirely on exchange-traded funds. And later, the view from Asia. How will those economies weather the economic storm? And are there lessons to be learned from Japan's troubles? Stay with us on Money and Markets.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
Welcome back, everyone. The U.S. economy may be headed into the second stage of a double-dip recession, and in such a scenario, your top priority, of course, is protecting yourself. Exchange-traded funds offer several ways to do just that, and joining us from Austin, Texas, is Weiss Research ETF expert Ron Rowland. Ron, what is the safest play in the ETF market during a double-dip recession?
Jamie, for the majority of the world, safety means U.S. Treasuries. But there's lots of different Treasury notes. Some are safer than others. Those with longer maturities, like 30-year securities, are much more volatile and more susceptible to losing value if interest rates should happen to spike up. Now, during recessions, the Federal Reserve likes to reduce interest rates, but I don't think the Fed has any room to lower them at this time. So the Treasury notes at the very short end of the spectrum may not benefit during a double dip either.
Okay, Ron, where is the sweet spot here then in the Treasury market?
Well, that's the 1 to 3 year maturity range, and that's why my first pick is the iShares Barclays 1 to 3 year Treasury Fund, ticker symbol SHY. It's your safest bet among ETFs that invest in U.S. Treasuries.
And Ron, presumably if Treasuries are going up during a double dip recession, then of course stocks are going to be going down, right?
Right. And that's why my next pick is a fund that shorts the broadest U.S. stock index. It's the ProShares Short S&P 500, and it's just what it sounds like. It moves inversely to the S&P 500. But SH is just one example. There's dozens of ETFs that provide inverse returns to various stock indexes. Now, many of them also use leverage, allowing for even more aggressive strategies.
Okay, so the broader stock market will certainly fall during a double dip recession, but what sectors are likely to take the biggest hits here, Ron?
Consumer spending always suffers during a recession, and in particular, consumer discretionary spending. Now, that's very different than spending on consumer staples like food and medicine, which usually hold their values during recessions. Consumer discretionary stocks cover things like luxury goods, new cars, fancy restaurants, travel, items that are nice but not necessarily needed. So I would tell investors to stay away from any ETF that targets these types of companies, such as the SPDR Consumer Discretionary Select Sector, ticker symbol XLY.
Ron, one other sector that I know that just got crushed during the last recession was, of course, the industrial sector.
That's right. The U.S. industrial sector has become much more cyclical, and its fortunes are tied closely to the economy. So industrial stocks took a big hit during 2008, 2009, and they've rebounded sharply over the past year, probably more than they should have. A double-dip recession would really knock the wind out of the sails of this group, so I would avoid any ETF that focuses on the U.S. industrial sector.
Okay, Ron Rowland from Austin, Texas. Thank you, Ron.
Thank you for having me, Jamie.
Coming up next, we're going overseas. Our analysts in Bangkok, Thailand tell us why Asia might be your best bet to protect yourself from the coming double-dip recession. And why can we learn a lesson or two from Japan's lost decade? That's all coming up on Money and Markets.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates, and that's what my colleague Nilus Mattive covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer, and I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
We've heard that the U.S. economy is sliding unstoppably toward a second recession, and we have heard how you can protect yourself using dividend-paying stocks and exchange-traded funds. But what about the asset class that's already benefiting from a flight to safety? Larry Edelson is a natural resources expert for Weiss Research. He joins us from Bangkok. Larry, what's the view from Asia looking like this week?
Well, as far as the U.S. economy goes, Jamie, I think it's time to stop talking about a recession and start talking about a depression in the United States. Just look at California's budget problems. Look at the 30% unemployment in Michigan. Look at the 46 out of 50 U.S. states that are broke. You know, I said 2 years ago we were heading into a depression, and I think we're there now, Jamie. The proof is out there for anyone who wants to look behind the superficial numbers Washington puts out, especially the GDP figures.
And why is that, Larry?
Well, for a couple of reasons, but most importantly, you know, whether it's 2% or 3% growth you hear out of Washington, it means nothing when the Federal Reserve is printing money hand over fist and devaluing the dollar. You know, the clearest way to understand this is by looking at the country's GDP in terms of how much real money it can buy in the form of gold. Viewed that way, the U.S. economy has already lost more than half its value since its peak in nominal GDP back in 2000. You know, that's a depression, pure and simple. Part of that equation, of course, is the rising price of gold, but it's also because the value of the U.S. dollar has fallen despite its recent rally against the euro, for example. I expect these trends to continue with the dollar collapsing further and gold soaring even higher.
Larry, we're going to hear more about your specific target for gold prices coming up in next week's show. We're going to devote the entire show to that topic. But where else can investors look right now if they want to protect themselves from another U.S. recession, or, as you say, a depression in this case?
Well, they can look to other currencies that don't have the same problems as the dollar or the euro. Take the Australian dollar, for example. Australia's economy relies heavily on commodities, exporting them. So as commodity prices go up, the value of its currency goes up as well.
And of course, the Australian economy is also heavily dependent on Chinese demand, right?
Absolutely. And that's another place investors should be looking. You have to go where the growth is, and the growth is in Asia and the Pacific Rim. Some of those equity markets are pulling back recently, but I think that represents a great buying opportunity. I especially like Chinese small cap and mid-cap growth stocks, as well as some Chinese blue chip stocks, mainly in the natural resource sector. Those are the areas that could do very well in the coming months, no matter what the U.S. economy does.
Okay, Larry Edelson out of Bangkok, thanks so much for being here.
Thank you, Jamie.
Okay, let's dig a little deeper into Asia now. How would a U.S. recession affect economies there, and what can we learn from previous recessions on that continent? Tony Sagami is Weiss Research's Asia specialist. He's also in our Bangkok studio. Tony, how would another downturn in the U.S. hurt Asia?
Oh, hi, Jamie. You know, it certainly would hurt a bit because China and other Asian countries do export quite a bit to the U.S. But even if the U.S. and Europe are in recession, many Asian